Most traders lose money because they enter at the wrong time. Today, I'm going to show you the exact entry models I used to help me make over $1 million from trading in just 2 years, and break each one down step by step. If we haven't met yet, my name's Kyle, and I've been trading the markets for the past 14 years. But just in the past few, I've been able to refine my strategy, and I've since gotten over 200 payouts, totaling over $1.3 million. It took me a really long time to become profitable, nearly a decade, which is why on this channel, I'm sharing all of my experience and knowledge so you can shortcut your journey to becoming a profitable trader. But enough of that, let's get right into the video. Okay, the first entry model that we're going to cover is just basic premium and discount. Now, we're going to use our Fibonacci retracement tool to be able to determine the range that we're specifically trading in. Now, what we're going to do is anchor that Fibonacci tool with a swing low point and a swing high point if we're bullish, and a swing high point and a swing low point if we're bearish. And what that's going to do is just plot out specific ranges. We're going to be able to see where 50% of that range is, as well as deep discount and premiums. So that's the first part. We need to identify those swing points. Next, we're going to wait for a retracement to below or above 50% of the range into discount or premium before hunting an entry. Then we're going to target a fib extension outside of the range or the range high. So if we're bullish, we're just waiting for a retracement down into 50% or discount of that range. And then all we're going to do is target the high or the low. So we're just going to target this high or the fib extension target. And if we're bearish, we're just going to target the low or this fib extension. All right. So getting into some of the examples. Now, the entries, we don't necessarily need to wait for candle confirmation when we're trading in this specific manner. So as you guys can see, we have a swing low here and then a swing high. And then all we're trying to do is place our entry somewhere inside of here. Okay, so we have our swing low here, our swing high here. And then all we're trying to do is buy it below, as you guys can see, 50%. So based on this swing, right, from low to high, anywhere in here is going to be a discount. Anywhere below 50% is going to be a discount. So anywhere in here is going to be a good place to buy. Now, this actual entry model can work really well with limits if you're not trying to be in front of the charts all the time and you just want to be able to set your limits and stops and targets and just walk away. So what we're going to end up doing is, entering long on a buy limit and placing our stop loss outside of the range. Now, this is very important. When I first started trading, premium and discount, I would try and tighten my stop loss really tight. And those trades would eventually pan out because I was just impatient. I was trying to move my stop loss too aggressively. And this is kind of where you're going to get chopped up. You're going to get chopped up a lot because it's coming back to discount numerous times. Okay, so it's coming into discount here. We're tracing in a discount again here and here. And meanwhile, this trade setup is not invalidated yet because this is really where your stop loss should go. So your stop loss should go where the swing point is. Okay, so that's just one example. And what we're going to end up doing, right, is just targeting either this previous high here, right, so outside of the range. So if you're going long in here, you're just exiting at the previous high. Or we can use fib extensions, negative 0.5, negative 1 as our targets. You guys can see here that it hits negative 0.5 pretty much on the dot and then collapses. All right, so these are all mathematical levels that many traders use to base their trades off of, just based off of premium and discount. Here's another bearish example. Okay, so we're looking at a swing high point and then a swing low point. Then all we're doing is placing a sell order in a premium. Now, again, your stop loss placement is going to be pretty vital for this trade panning out, because if you move your stop loss too aggressively, let's say this market dumps like this and you move your stop loss too aggressively, well, the trade still hasn't yet been invalidated. Now, if you're only targeting the low, you've already been out here. But let's say if you're targeting 0.5 and you moved your stop loss too aggressively, well, it's going to come back up, maybe take out these highs here, right? But this entry model, right, where we have this as our invalidation. This is the real invalidation up here because that's where we're drawing our swing point from. That hasn't been invalidated. So this trade eventually, right, trades down to our fib extension. Now, when you're determining the range is so important because not all of these ranges are going to be ones where we want to trade. Now, if we have a really strong displacement, that's usually where I'm going to draw my Fibonacci retracement tool. Okay, so those are just two examples. Now, premium and discount entries are great, but what if I told you there's a way that you could spot where price is about to explode with momentum? Now, this next model helps you identify zones where smart money is possibly loading up on positions. But first, if you guys want a detailed PDF guide covering all of these setups, just make sure you download my ultimate guide to trading executions. I'll leave that link in the description. So this next setup is probably one of the most powerful setups if we can point them out and be able to get proper entries with, and that's liquidity raids, or otherwise known as turtle soups. So firstly, we're going to determine the liquidity pool that we expect to be rated. Now, this can be a previous weekly high or a previous weekly low, as noted by these acronyms. Previous weekly high, previous weekly low, previous daily high, previous daily low, or previous session high, previous session low. Now, that can be in the form of Asian range lows or London range lows, etc. But all we're going to do is wait for one of these levels to be rated. Okay, so what we're going to plot out, let's just pretend that this is a previous weekly high and previous weekly low. And this is kind of where I messed up when I was first starting to learn how to trade these setups, was once it's rated, we are not going to just enter as soon as it takes out that level. Because when we do that, we don't have a proper place or a logical point to put the stop loss as soon as it takes out that level. Instead, what we're going to do is wait until we get a closure back inside of the range. So after we take out that previous weekly high, what we're going to do is wait for a closure back in the range. And you guys can see here that this candle provides us the closure back inside of that range. So again, we need to see a strong rejection and close below above that previous swing point. We can then enter the position with our stop above or below that newly created swing. So here we have a newly created swing point, as you guys can see here, as we've created this high, right, a higher high, and then a lower high to the right of that. Okay, so that creates that swing point. So when we're going to enter our short position, this now becomes our logical stop loss. And this is where I lost a lot of money throughout the years trying to learn liquidity raids, was I would just enter as soon as we penetrated a level. But I've found that the better risk reward and the better higher probability trade will come when we wait for that closure, because it's just going to show us the rejection. We don't want to be the first people or the first traders to hop on a move. We want to be able to wait for the market to tell us that it's ready to turn around. Okay, so as an example, and for some of you guys' homework, just like in the previous example, this all requires you to go in the charts, do your homework, back test examples, forward test examples, and write all of these examples down in your journal. So as you guys can see here, we ran out this level, and instead of entering it as soon as we flush out that level, we're going to wait for a closure back below that high. So previously I would, enter short, but the problem is as soon as you enter short, as it's penetrating that high, you don't know where to put the stop loss. Now here, after we get the rejection, we have a valid area where we can place the stop loss. It can go above this high. And I gave it a little bit more room just to account for spread or any manipulation. Okay, so I'm entering it on this candle or on this candle here, and my stop loss goes above that high that penetrated this previous high. And all we're going to do is target where? The opposing end of the range. Okay, so we're just targeting the other end of the range. Now this trade ends up being, I believe, a 1 to 2 or 1 to 3. And here, same example, we're not entering on the penetration of that old low. We're going to wait until we get a closure back above. So as soon as we get this closure on this candle here, now the time frame doesn't matter. These models will work on any time frame that you choose. We're waiting for the closure back inside the range. That's going to give us the indication that this market's ready to turn around. So all of a sudden, we have our entry at the closure of this candle. Our stop loss goes where? Below the low that took out this prior low, and we get the rejection. And then all we're going to do is target the high end of that range. Okay, this trade ends up being, I believe, a 1 to 2.5 or 1 to 3. One more example here. Again, we are not entering on the actual run of that low. We're waiting for a closure. Now, yes, you can possibly jump the gun and try and enter down here and get really tight risk reward, but I found that a lot of times you're going to get stopped out because this market may continue running lower before it turns around and goes higher. So I prefer, again, waiting for the closures back inside of the range because that's telling us that there's a real strong rejection there. Once we get the rejection, right, enter long again, stop loss goes here, and again, we're targeting what? Just the opposing end of a specific range. Now, this trade you might not even take because let's say if you marked out this as the opposing end of the range, this risk reward might not be good enough. All right, that's for you guys to go and backtest and for you guys to actually get examples on forward test, put together a full model. Now, liquidity is powerful, but there's one entry model that is actually one of the first concepts that I mastered that led to my initial consistency, and it works in any market condition, and that is fair value gaps. These are one of my favorite models, entry models to use. Now, what makes a fair value gap? Really, it's just a 3-candle pattern where we have one candle here, we print another candle, and then the third candle does not fill in the second candle's body. So it leaves a gap. So if we look at this high and this low of this candle, right, there's no price action that occurs inside of this body. So as this candle's printing higher, right, this candle here does not come and retest that level before it goes higher. So when it does, that provides a fair value gap entry. And vice versa, as a bearish fair value gap, when we trade higher into that fair value gap, that becomes an entry point. So next, we're going to wait patiently for the market to rebalance into the fair value gap. Our entry should be placed as the market is trading against our order flow direction. So if we're trying to go long, the candle should look like this as it's trading into it. And these are the best entries that you could possibly get because you're going to get a better fill. Now, just imagine if you're entering it here and then all of a sudden this candle closes bullish. Well, if you're buying it down here, right, it's better than waiting for the candle to close bullish and then you buying it. Okay, so this entry down here is going to have a better fill price than if you waited for it to turn bullish. So, a lot of people ask, what is your confirmation on this specific entry? A lot of times when I'm entering the market, it doesn't really look great. And oftentimes those are the best entries to have because you're going to get a better fill price. And then your trade is confirmed after you're already in the trade. All right. Vice versa, for bearish fair value gaps, you're trying to sell it as the market's trading against you. Now, there's multiple different ways that we can use stop losses with fair value gaps. Unlike the prior examples where it's very black and white, where you should put your stop losses, fair value gaps are a little bit different because you can get aggressive with the stop loss placement, or you can have a more conservative stop loss placement. So aggressive, in my opinion, would be using the low of the fair value gap. So as you guys can see, this here is our fair value gap. Sometimes you can place your stop loss at the low end of the fair value gap. Another aggressive one is to place it at the second candle that created the fair value gap. But the most conservative is placing it at the low end of the candle that created the fair value gap. So if you're going to count all these candles, right, 1, 2, and 3, the most conservative stop loss is going to go at the low or the high of candle number 1. Aggressive will be at candle number 2 or that fair value gap low. Okay. Bearish example, again, aggressive will be either this one, right? So the high end of this bearish fair value gap or the actual high of candle number 2. But again, the most conservative stop loss placement will be at candle 1 here. Just a couple examples for you guys here. We have this bearish fair value gap, right? And this is just assuming that we're going to enter as soon as it's touching the fair value gap. Okay, we're not waiting for this retracement here. Now, again, if we placed our stop loss where aggressively, the high end of this fair value gap could work. The high of candle number 2, but most conservatively is going to be the high of candle number 1. Okay, and you're still going to get a really good risk reward out of this specific trade because I believe this is a 1 to 2.5 or 1 to 3. Okay, and we have to give this trade room to breathe. This trade is not going to go directly to our target. We have to give this trade to move around and chop around. Because as long as we don't lose this fair value gap, the trade is valid. You guys can see how many times it retested this fair value gap and respected it. And then traded lower. Okay, and it even retested up here again. All right, here's a bullish example. Again, there's numerous ways to have a stop loss placement, but again, the most conservative is placing it here where candle number 1 is. As you guys can see, we had this bullish fair value gap, but oftentimes if you have an aggressive stop loss, what happens is they'll take you out before it goes in that direction. Okay, so having that conservative stop loss is oftentimes better than having the aggressive one. So here, as you can see, an aggressive stop loss here at candle number 2 would be okay if we use a low. But if we use the low of the actual fair value gap, you would have been stopped out. So a lot of times these candles will do damage against your position, but that doesn't mean that you're getting the analysis wrong. It just means that your stop loss placement is wrong. And what I had to learn over time was I need to pay attention to all these setups that I'm marking out on my charts, because it's going to allow you to get better at stop loss placement. It's going to allow you to get more comfortable with the trade moving against you and assuming that risk, because when we enter the trade, we don't know that the market is going to go sideways like this. That doesn't mean that the trade is wrong. Even if you get stopped out, that doesn't mean your trade is wrong. It just means that your stop loss placement was a little bit too tight. So when you're reviewing your journals and you're going through these setups and you're trying to analyze if you're doing things wrong or right, oftentimes you could be doing everything right. It's just the stop loss placement that's causing you to get kicked out of the trade before it goes in your favor. And that's something that I had to learn over the years, is when I'm trading these setups, just because I got stopped out doesn't make it a bad trade. It's really just being able to manage the trade more effectively, having better stop loss placements, having better targets, things like that. It doesn't mean that these setups do not work. It just means that the market is a bit more random than you think it is. Now, fair value gaps are one of my favorite setups, but what if I told you that there's another setup that's even more powerful when you combine the two? Now, we're going to jump into order blocks. Now, an order block really is just a down close candle prior to a run higher, and a bearish order block is a up close candle prior to the run lower. And when we're trying to find a valid order block, and this is where I took too many order blocks that really weren't high probability order blocks, oftentimes an order block will be paired with a fair value gap. So when we pair the two, that becomes a high probability order block. So when we have an order block with a fair value gap resting above or below it, that becomes a much higher probability level where we can buy or sell. Okay, so when we're trying to buy it, all we're trying to do is enter in that specific level as it's trading into that order block. So as you guys can see, this next candle is trading down into this order block, and then we're expecting a rejection away from those levels as the candle's forming. So here, as you guys can see, we have these consecutive candles here. So I'm going to use all 4 of these candles, 1, 2, 3, well, 5 of these candles as an order block. But as you guys can see, it's lined up with a fair value gap. So that, in my opinion, makes it a high probability order block, not just any typical order block. So once we get a retracement down into that order block, we're going to go long. You could use a limit and just target a specific level up here, right? We have a gap up here that we're possibly targeting. Here, another example, we have these 2 consecutive candles, but we also have this bullish fair value gap here. It's resting above the order block, but it does trade down into that, and you guys can see how the bodies of these candles respect that level. Now, as it's trading down, this wick, right, might be getting a lot of people offside, so a lot of people might be shorting into this level, but as you guys can see, is respecting that fair value gap and respecting the order block. And finally here, we have this order block, where we have these consecutive up close candles, but it's also paired with a fair value gap. So when we have this fair value gap overlapping with the order block, that becomes a high probability order block. So as we're entering it here, our stop loss can go where? Above the high of those consecutive up close candles, and then we're just going to target either the low or a little bit lower. Now, order blocks are great. I use them a decent amount, not as much as fair value gaps. But what if I told you there's something that combines both liquidity and order blocks to create an extremely high probability setup? And that is breaker blocks. So what is a breaker block? Really, it's an order block that's formed prior to the raid on liquidity, and then we break below or above that prior order block. Okay, so here you guys can see that we have this order block here. It's created prior to a run on liquidity, and then we get the liquidity raid. Not only that, but it breaks below that order block. So now this level here becomes what? A breaker. I'm just going to simplify it by putting BR. So what we're going to do is enter as it's trading back up into that breaker. So we can sell short on the retracement into the breaker, but there's a couple different options for stop losses. And this is kind of where breakers get a little bit messy because oftentimes it's not very clear where to put the stop loss. I often err on the side of more conservative just because I don't like getting tagged out of the trade before it goes in my favor. So oftentimes I'm using, maybe the high of the fair value gap that's created, or maybe using one of these highs up here. Okay, here, again, very, very aggressive stop loss is going to go at the low of the actual breaker. I will typically give myself a little bit more room because I've seen these trades where, they trade lower, lower, lower down into a fair value gap, and then that candle creates a really long wick. So oftentimes the breaker will stop out a lot of people before it runs. Okay, here is an example of a breaker. So we have this order block prior to the run on liquidity lower. So here's our sell side liquidity. As we break through that level, this here becomes a breaker. Okay, and I'm just drawing out the high and the low. So extend that all the way across. As we're trading down into it, right, there's a couple different areas we could have a stop loss. Because it's overlapping with this very large fair value gap, you can use 50% of the fair value gap possibly, and that's okay because it lines up with the low of the breaker. Maybe you could use the low all the way down here. Either one I think would be okay, just based on how far this market runs higher. And then a bearish breaker. Okay, so we have this order block here prior to the run on liquidity. So we ran out this buy side liquidity. We ran out that liquidity, broke below it. Retracement, you guys can see how much damage this wick is doing, right? That's where your stop loss placement plays a major role in if you're going to get this trade right or wrong. So when we have a really large fair value gap like this, and you guys can see it trading through 50%, maybe you want to use the order block, 50%, or the actual body or the high, some level up there that's a little bit more conservative. Because as you guys can see, again, this breaker obviously sent price much, much lower. But if you're getting tagged out because your stop loss placement is wrong, does not mean the trade is wrong. It just means that your stop loss is a little bit too aggressive. And final example here, we have a bullish breaker because it's our order block prior to this run on sell side liquidity. So we've taken out sell side liquidity, broken above it with the closure of this candle. So this candle closes above it. We could pretty much enter on any of these candles here. So any one of these candles would be a good entry. And then obviously stop loss placement could be a little bit aggressive where we have this fair value gap and then we're just targeting higher. All right, understanding these concepts is one thing, but having the right context and mindset is more important. That's why I put together 7 of the biggest lessons I learned after making $1 million in the markets. You guys can check that video out right here. And as always, thanks for watching, and I'll see you guys in the next video.